All right, welcome everyone. This is Bob Maury. It is Wednesday the 24th of July, around about 2 o'clock my time. I want to do a deeper dive into the couple strategies that I introduced in the last video. Make sure everybody's on the same page here for these new ones. So let's hop on over to it. And if you download into the portal, bring up the PDF version, you'll find those right here. So 314 bear spread live cattle. 315 bear spread natty gas. Okay, for the live cattle, I've already got the levels because that one started back on the 19th. But for natty gas, that one actually we need to wait till today's close, and then we're going to wait for today's close, which is day 0, and add 9 or 21 for the entry levels, and then we'll do the math for the exits. So let's just hop on over to the charts and see how it looks. Okay, so first of all, 314 bear spread live cattle. Long the April contract, short the Feb. Margin requirement 330. Risk reward for the level 2 traders. More conservative entry, risking 220 per spread to make 520 or 780. And then for the more aggressive average in traders who get in at both levels, risk is about 640 per 2 lot that you average into to either make 840 or 1360. If all you do is get that first level and then the market breaks down to our target, the gain would be about 320. All right. Entry levels. Well, let's talk about the backstory first. So, the reason for publishing this strategy is it's been a profitable endeavor 15 out of the last 15 years. However, that doesn't mean that there's no risk, right? So, most of the time, in my estimation, the risk was a couple to maybe a few $100. But there is one year that kind of sticks out, and that was 2015. In 2015, at one point, even though the strategy ended up profitable, you had to withstand an unrealized loss of $1,110 at worst. Sizing up that year, 2015, with the chart you're seeing in front of you right now for the contracts we'll be trading. Okay, this chart. I don't see a whole lot of correlation in terms of the incoming price, so where it was on day 0, nor the structure of the market, so the chart structure. So I don't think that has a high probability, not a no probability, but a high probability of recurring. So that's that. So the next thing is, what kind of range are we giving this in terms of our stop level? And our stop is at negative 87. Our entry level here, or day 0, I should say, the benchmark is negative 192. That's a difference of 105. Each point in cattle is $4. That's a $420 range between here, where we can get stopped out, and here, where the strategy started. And if you were to have given the market $420 worth of room over the last 15 years, it would have been enough 14 out of the last 15 years. The outlier being that year I mentioned in 2015, where it had the outsized unrealized loss. So that is telling me that this should be an ample amount of room. 2015 was a bit unusual. 14 and 15, there was a pretty good rally in the cattle market for several reasons. So I don't think we're in that same type of structure at the moment. Okay, so what's our entry? Well, first level is right about where the benchmark was at negative 192 or better. And obviously you can do or better if you waited till now to do this. And then the entry level 2 is negative 142, stops at negative 87, targets negative 272 and negative 337. I'm going to call this more of a range bound trade. Obviously the seasonal is in the driver's seat, but I'm going to call this a range bound trade. Basically been big picture from negative 2.5 up to about negative 1.25. So 125 point range. That's a $500 range. Okay, big picture. More recently, negative 220 up to, without the spike here, negative 220 up to negative 150. So about a 70 point range. $280 range is what that equates to since about May. So range bound, big picture, range bound, short picture, shorter term. We just need this thing to rally up, stall, and then push on down. Now we will need it to make new swing lows, so we need to find some good catalyst to push this one down once it runs out of buyers up top here. All right, so that is strategy number 314, bear spread live cattle. Then the second one I introduced was natty gas. So first of all, in yellow here, strategy number 315, bear spread natty gas, long January, short December. Margin requirement 212, that's manageable. Risk reward for the more conservative entry level. Level 2, that is, risking 170 per spread to make 440 or 550. And then for the more aggressive average in traders, risking 460 per two lot that you average into. Try to make 760 or 980. And then if all we do is get first level, and then it breaks down to the first target, that'd be 320. The strategy is going to be to get short. Reason being, backstory on this one, it's been profitable 14 out of the last 15 years. The losing year was 2018, lost $200 that year. But in my opinion, sizing up the incoming price and the structure of the chart relative to the one that you're looking at there that we'll be doing, I don't see a whole lot of correlation, so that doesn't overly concern me. There was no unrealized loss year that turned profitable that really stood out to me, so it didn't seem like there's any kind of outliers there in terms of kind of heat that you'd have to withstand to be in the market. Benchmark to stop range, $380. So 0 plus 38. Okay, we'll wait for today's close, but either way, we're adding 38 points. Each point in natty gas is $10, so that's 380. The benchmark to stop range is 380, and that has been enough to withstand unrealized moved against us 14 out of the last 15 years. It is tied with 1 year in the past. So, trader's prerogative. If you want to stretch that out a bit, make sure you've got more than ample room to withstand the closing basis unrealized loss over the last 15 years. Feel free to do so. I'm going to keep it there for right now. I may adapt on the fly, but for right now, I'm just going to keep it where it's at. So what are we looking to do? We're looking to get short. Where we're looking to get short, we're going to take today's close. We're going to add 9 points for the first level, 21 points for the second level, 38 points for our stop. We're going to take that same close, subtract 23 and 34 to get our targets. Real tight range so far. Obviously, you can see that basically between negative 271 and negative 250. So give or take about a 20-point range for quite some time now, all the way since looks like the tail end of April. And each point in natty gas is $10, like I said. So $200 range, pretty tight so far. So we just want this thing to go up here, revisit the top end of the range, and then break on down. All right, so that is strategy number 315. You got the risk reward, you got the entries, exits, you got the backstory on this one. So that should be a complete plan. All right, if you have any questions, comments, anything of interest, feel free to let me know. I'm going to leave it there, and thanks so much for watching.